All right, good morning, good afternoon. So let's continue from where we stopped earlier. It's still the same. All right. So, and if you're watching this from the recording, you're welcome. And if you're watching this from YouTube, you're welcome, whichever medium you're using. So let's continue. We've done Monday's morning session backtest, and this is the Tuesday section. So we indicated our price created this model, this mechanical cell model. From the first stage, dropped lower, created another block, and then rallied higher for the second stage, traded just above this volume imbalance here. So you had this volume imbalance here, price traded inside of it, dropped back and traded inside of it again, and then price traded up above it like this. So this is an indication for lower prices. Yeah. So I'm interested in this purple fair value gap here, which is now we have multiple confirmations behind us, behind our trade idea. We are currently above the midnight opening. We are currently, let's see, the 8:30 when the equities market opened. So we opened here. So we went above the 8:30 open here at 9:20 here. So the market has already been disposed to go lower pre 9:30 because the Judas was taking place here. The 8:30 to 9:30 formation of Judah. That's 1 hour time cycle. So yeah, they're getting this highs 1, 2 above this side here and this imbalance here, which is this fair value gap here. So on your own, you can take the low of this candle to the high of this next candle, or use the body, the top, the highest body, because the imbalances can overlap one another. Like this is, in this case, you have, what was this? So in this case, you have the purple. In this case, you have the volume imbalance overlapping this fair value gap here. So you indicate all of that together. It's like you trying to indicate this fair value gap. You can extend it from this low to this high because the algorithm sees all of these as one set of imbalances created at the same time. All right. So that is it. We're targeting these lows here after this purple. Traded out below Sunday's opening. Now this is an indication for higher prices because price is not spending too much time below Sunday's open. Price do not spend too much time in a discounted market. So below Sunday's open is a discount market. Sunday is fair value. So price kept leaving this PDRA. So we had this low left here in price, so sell side will be resting below here. So yeah, we have Wednesday's trading. We have this buy side above here. Remember, you are expecting higher prices from the beginning, from the first part of this video. Now you have sell side here, and here you have buy side. So price valid higher, left this imbalance here, and this imbalance also, a long wick is seen by the algorithm as an imbalance. So you look for the midpoint of it, which is the constant encroachment. So this imbalance, this imbalances, they are all overlapping. This is the idea I'm trying to convey to you. This is like the gray pool concept, but this is with PDRAs, multiple interlapping PDRAs. This is the first time I'm being introduced to it. So you just look for the midpoint of this wick here, and you anchor this here to it and join it. Then you look for the midpoint of that midpoint. Look for the midpoint of that midpoint, and as you can see our price is expecting that midpoint here. We left another block just at it, and then price chase right into it to this position. The gray concept is a precision concept. So it's like a litmus test. So it seeks precision. So you have this relative equalizer here, you have buy stops resting above this, and then you have buy side liquidity here. So doing this, all this occurred during London's session. This is the mechanical by model. So price valid here. What is this? So you have the money session. After price rated buy side liquidity, you have a gray pool here. So look for the midpoint between these bodies. This candle's wick, the midpoint, and these bodies. This candle, the midpoint. Look for the midpoint of that midpoint. That's the gray pool. You have a rejection of that gray pool. The gray pool there is acting as a resistance. Then you have this rejection block, this IS body here. So here was indicated as X. So if you watch the Wednesday's video, here was indicated as X. X is for a rejection block. So X is equals to a rejection block if you are doing this as something mathematical. So price dropped lower here and left this breakaway gap here, and also this imbalance here. Wicks are imbalances, remember. So the midpoint of it, price rebalance this imbalance here. So this up close candle now is the other block, and the eye of it, because in this swing point, this is the highest body, this is a rejection block. It's like X times 2. This is a factor nature in price. Price is factor. So what you're seeing here on the 5 minutes, you can streamline it down lower to the 1 minute and you look for your entries there. All right, so this is X. This is a rejection block. At this other block here, if you stretch that out in time, this is price respecting the other block here at 11:33. So at 11:05, we traded inside of it for the last time. So we start trading inside of it here at 11:35. Sorry, 10:35 to down to 11:10. So at 11:10, we were really eager now to go lower, because this is price tricking the uniform that this is a strong low. So because they'll place their this thing here, their support level, all those lines they are placing from those higher time frames, they will be transposed there. So here will look like a support, a very strong support level before all of this is done. So I doing an exercise now. I take it you're paying close attention to this video. Now I want you to take your right hand and put on the screen where you're watching this video, whether it is on your TV, whether it is on your mobile or on your laptop. It doesn't matter. This is one, nobody in your family should be seeing you watching this, all right? Because now when you tell them you are trying to understand how the algorithm that books price is booking price, they'll look like you're a madman. So just watch this in your solitude. Guard your fortress of solitude, where you learn, where you used to study. Do not let that be corrupted, right? So guard your fortress. So now we're doing an activity. Take your right hand and place it on the 10:30 candle. So when you place your index finger on the 10:30 candle, then your palm, the front of your palm is blocking the right hand of your screen where you're watching this. So now I want you to slide your hand to the right slowly. Your right hand, slide it to the right. And now imagine that you are watching a live price action. Do not use a replay button for this, because a replay button, you're already seeing the move already, but now you're blocking it. You're blocking it, you're not seeing anything, and you're true to this. So now you're watching it. You're watching this imbalance on the midpoint on this imbalance on the 10:20 candle and the breakaway gap. You are expecting price to probably trade inside of it. If price doesn't trade inside of this breakaway gap, means we are extremely bearish, but we leave room for allowance for it to trade just at the tip of it, which is an institutional order flow entry. You see, you do not actually know which of your PDRA will manifest itself. You just need to understand those PDRAs, and when you are tuning your model, when it is time, you execute with whatever PDRA presents itself to you, whether an order block, a fair value gap, a rejection block, a sweep of liquidity, which is a total soup, any of it, right? So as long as it is in line with your model. So we rebalance this imbalance here. So start sliding on to the right slowly, as slow as possible. As you move, you identify. So another block was created with these two candles valid here. Rebalance this imbalance here. You stretch out in time. So this now is an intermediate term high. So you don't want this intermediate term high to be violated. So you are looking for this to be protected. So price verify this as an intermediate high, so you can make use of this or this. If you're making use of this as an intermediate high, you are looking at this to be a rejection block. But if you're using this as another block, you're making this an intermediate high. If you look at the high of this week here, you see this, the high is 5736.9. The high of this candle here is 5736.27. Yeah, the high of this candle is, these two are the same highs. This high is higher than this high by 0.2 point ticks. So you see, it didn't violate this intermediate term high. So here you have a short term high, and at 11:10 price is eager to go lower. So we have that here. So the rest of the video will just be me annotating the rest of the days, because this is Thursday, Wednesday, so we've already reached the highest high we're expecting price to go to throughout the week. So on Thursday's trading, we're expecting a reversal. So I already covered, I'm not going to cover this thing a second time. I've already made an in-depth explanation of this Thursday's price action. The video was released yesterday, being Friday, and that video was the hardest video I ever created, because let me not speak. So you go and watch this. All of this has been indicated by side rated probable going for lower prices. Thursday reversal using the TGIF model. On Friday we have this price action. I didn't participate in Friday's trading. We're only back testing. We're only typically reading live, so we had this imbalance here. So we're expecting price to go higher, because we already anticipated that to be our Wednesdays, that Thursday's reversal to be our reversal for the week. So the video of this Friday's trading was also released yesterday, being Friday, so you can go watch Thursday's and Friday's video. All right, so I hope you got something from these videos, this series of videos. So this is a two-part. So, and if you are learning this live, if you have any questions, you put it on the Telegram community tab, and we'll get right into it. All right, and goodbye, good luck.